all of us felt that transmission of the heavy dose of repo rate cuts in the past was still happening.
Okay.
And we wanted to wait for that to be fully transmitted before we consider and look at other options and other actions.
Okay.
And the uncertainties, how they are being resolved, how much of impact or incidence on growth and investments there is going to be. So we wanted to, come back to the next meeting when things are a bit more clear before taking a decision.
Okay, fair point, sir. Actually, your set of minutes are extremely instructive because you are giving us a lot of minute details on the impact of the US tariffs. You point out that although India's merchandise trade is only 20% exposed to the US, the labor-intensive exports are exposed to the extent of 33%. Do you therefore expect a fairly big impact on growth in the second half? Because, a lot of MSMEs could be hurt.
Yeah. Well, as I said in my minutes, the impact on growth, I'm not too much worried about because it may be, between say 40 basis points to 60 basis points, if in the worst case scenario. But I was more concerned about the impact on jobs and particularly MSMEs and the jobs that they create and sustain, because although United States is a market for 18 to 20% of our exports, merchandise exports, but they are much bigger market for our labor-intensive industries such as textiles and garments, gems and jewelry, processed foods like shrimp, the leather goods and all that. And these are the industries which are dominated by MSME. They create a very large proportion of jobs. Actually, the labor-intensive industries account for 40% of total manufacturing jobs in India. So if 33% of their market are in United States and that is affected, so there is a prospect of some impact on the MSMEs and jobs, but it's not that no action will be taken to take care of or address this.
Okay.
So I have also talked in my statement that we need to find alternate markets for these exports, which will be possibly affected. One is the exploitation of the domestic market fully. And for that, government's reforms on GST side, the GST 2.0
should help.
Is helpful, and early indications suggest that boost to demand is showing up. The other is to find other export markets, diversification of export market, and in that context, the India EFTA, European Free Trade Association EFTA, which became effective from 1st October, is helpful. The UK-India FTA, which was signed recently, is helpful. The expediting the negotiations of India-EU FTA is also going to be helpful. But I also mentioned that we should also fully harness the potential of India-Japan, India-Korea, India-Australia, India-UAE FTAs, which are already in place.
Yeah, actually, all that the statements that you make are running on our screen as you speak. The main points that you make. I wanted to just ask you, sir, that since inflation is undershooting, now I took a poll of professional forecasters, and now the expectation is that the full year average may not even be 2.6, which the Reserve Bank forecasts. But after looking at the more recent numbers, it will probably be 2.3 or 2.2. That's the average I'm getting from about 10 economists.
It is possible. It is possible.
As well, the year-ahead inflation, which Reserve Bank forecast, they brought it down from 4.9 to 4.5. Now chances are it will be 4. So do you think the space opens up for more than just 125 basis point cut? Because inflation is really benign and WPI is at 0.13. I mean, there's hardly any core inflation impulse from the rest of Asia, and you will know that better as a trade expert. So do you think there is space for more than one cut?
Well, it is something which we have to see going forward, but certainly this kind of very benign inflation outlook and all the surveys are indicating that inflationary expectations are very well anchored. So this certainly opens up space for monetary policy action. And so this is the call we have to take when we meet next in December, and going forward, all the numbers, not only of inflation, which are going in the right direction in the sense that they are opening up policy space, but how much of impact the growth side is facing, or challenge growth side is facing, and how much support we need to give from the policy action. So this is something which will be certainly debated in the next committee.
A final question, sir. Do you think the Reserve Bank was too hasty in going to an accommodative stance? There are some in the market who believe that the transmission through the bond market got stymied, got stopped because this expectation channel was taken away because of the change in stance. You have actually even spoken about it. That's why I'm asking you. It would have been a better idea to retain it at accommodative?
Well, I and another external member did feel that at this point we could possibly change the stance to accommodative, which will be reassuring to the markets that the Monetary Policy Committee or policy action, supportive policy action, will be there if there is a need. However, there was, the consensus was not there. But these are things which are evolving constantly. So I hope next time around when we meet, we have seen greater clarity of the numbers and trends, and maybe there will be a greater coherence between all the members on this issue. In any case, the stance is something which is not voted upon. It is an individual view, and so I think next meeting will have more clarity on all the different dimensions of growth versus inflation, or growth inflation dynamics, and how much of action is needed. So we'll consider all of that.
Okay. So we're just out of time, but very briefly, do you think there is a major disinflation in Asia which may continue to impact disinflation in India? Chinese related.
Sorry?
Chinese dumping related.
No, I think some of it, of course, will be linked with the dumping of cheap goods. But on the other hand, I think the supply side is opening up, helping because of the good monsoon. The GST reforms are also helping to bring down prices, and some bit of sluggish demand in urban consumption probably is also behind. So it's a combination of several factors rather than one.
Okay, fair enough, sir. I was just swept away by the WPI falling so much. Thank you very much, Mr. Kumar, for joining us and helping us understand the arguments behind the MPC's action. We hope we will have an occasion to speak with you before the next meeting. Well, that's the word coming in from one important external member of the MPC. We have to take a quick break, but don't go anywhere. We have a couple of market participants, experts joining us, Axis Mutual Fund's Devang Shah and Abhishek Upadhyay of ICICI Securities PD, to give us their view of the minutes. Back in a minute. Welcome back to this special monetary policy show where we are discussing the minutes of the RBI's MPC, which have just been released. The overall or the single theme that the minutes exude is that there is space to cut, but perhaps it will be wasted in October itself. It would be good to wait because there's too much of uncertainty and therefore a rate cut may not be used well. That seems to be one of the main themes emerging from at least the RBI members and even the external members. To understand more and to understand how the market is interpreting these minutes, I'm joined by Devang Shah, Head of Fixed Income at Axis Mutual Fund, and Abhishek Upadhyay, Senior Economist at ICICI Securities Primary Dealership. Abhishek, Devang, thank you very much for your time. Abhishek, what did you take away? Are you getting a sense that MPC members are still very stingy about rate cut and we may at best get one in December?
Well, Lata, so comments make it clear that December rate cut is more or less a done deal. There is clear mention that there is policy space and members are only waiting for the monetary policy transmission to take place and for some clarity about global developments. If at all, the data which is being made available after the meeting was held, including on inflation, which was in line with market expectations, but details indicate and high frequency data for the current month, if you look at that, indicate that for October-December period, inflation could be tracking 1% versus 1.8% predicted by RBI, so sharply lower. Also on the growth front, globally, the eruption of US-China trade conflict has meant downside risk to growth stemming from the global side have also increased. So quite likely that December is more or less a done deal. But issue is market is already pricing in a full rate cut. The swap market is already fully pricing in a December rate cut. Issue is whether there will be more easing. On that, there is less clarity from these minutes. There are some comments coming from external member Saugata Bhattacharya, who's pointing to next year inflation profile, which is around 4.5%, which will be a sign that maybe scope for deep cuts is not there. If other members also start making similar arguments.
Okay. Devang, what have you taken away from the minutes as a bond dealer?
So, Lata, I agree with Abhishek. Largely, 25 basis in December is a done deal, because the minutes and all the policy members have actually put across very clearly that they have passed the October policy just because they wanted to see the impact of GST and get more clarity on the tariff rate. Our perspective is that the swap curve is pricing 25 basis completely, but the bond markets might lead to around 5-10 basis of other additional rally if the 25 basis rally rate cut gets delivered in December. Okay. I think the communication will be much more important, and if the tariff uncertainty continues, and I think at this point of time, there is no clarity that whether it is 25% or if this 50% continues for long. If this tariff uncertainty continues, I think the communication would continue to remain dovish, which then markets might price in another 25 basis rate cut in February, which can lead to additional rally in our bond markets. But at this point of time, I think today bond markets have drifted lower over the last 10-15 days. In fact, the 30-year bond yields are from its peak 30 basis lower. Ooh. So our view is that into the policy, we might see a 635 on 10-year, which is 7-8 basis from current levels. Very high possibility.
Oh, okay. Abhishek, are you... getting a sense, or can one argue that the inflation number is likely to be, as you pointed out, far lower than the Reserve Bank's lowered forecast of 2.6? I mean, they may be forced to come to terms with probably a 2.2 for the current year. And even the forward estimate that they are giving of 4.5 may have to be brought down closer to 4. So is there a door opening for more than one cut? Can you sense any of that at all in the minutes of more than one? Or are the minutes looking a little more hawkish? Will the market look at it as hawkish?
No, I don't think minutes are hawkish. For me, the reason why the monetary policy decision was dovish and the latest minutes are also consistent with that is that the committee didn't underplay the disinflation which is coming from the food side and from GST-related changes. Normally, these drivers of inflation
are
typically will not lead to easier monetary policy, right? Because next year inflation could be high for the same reasons.
Yes.
But there is no emphasis on these potentially one-off disinflationary forces, which is a sign that maybe committees is looking to leverage these favorable inflation optics to address any growth concerns.
Okay.
For me, the scope for cut after the next meeting in December should be heavily contingent on whether these higher tariff levies stick or not. If they don't and tariff levels normalize to rest of Asia levels, and if inflation is still lower but because of these drivers, then I would still think RBI would be well advised to take a more cautious approach and basically not cut further.
So you mean any rate action should depend on the growth worries and not be inflation driven? Is that what you're saying?
I think the best way monetary policy can support growth in this cycle is by keeping these rates for longer. Delivering that one extra cut led by which is triggered by soft food inflation or tax cut induced impact. I don't think that would be very wise tactically. As we saw earlier also during rate hikes also, RBI didn't go full hog and hike to the full extent. They stopped a little early, and that allowed them to basically deliver easier policy settings basically over a long time frame. So my sense is Feb or April rate cut will depend on growth-related concerns rather than inflation-related basically tailwind, which is a trigger for maybe a December rate cut for sure.
Okay. Just a final question, Devang. No joy for a trader, right? For a bond trader, I guess a few more basis points if December sounds benign. Is there otherwise there isn't much for a bond dealer either, right? For a bond bull.
Yeah, so completely with you, Lata. So from a monetary policy perspective, in fact, we saw that price action in bond markets. Like when June monetary policy, RBI commented that largely there is no or limited room for monetary easing. We actually saw yields going up.
Yeah.
So the last rate cut, if it is December or February, will not lead to any significant rally. The only joy which can probably, or the reason for additional rally which can happen in the next quarter, as per me, is that there is a high probability of Indian bonds getting added into Bloomberg. So they have started to review our index again and probably look at FAR securities, start the dialogue open. And they are consulting FPI investors. If that happens, I think that triggers another 15-20 billion of flows depending on our allocation, and which probably can come into, which can lead to positivity around bond markets, and we can see a 10-15 basis of rally. But very low probability of going below 6-quarter on 10-year GSEC at this point of time.
Okay, 6-quarter also looks quite ambitious, I must say. Because, I mean, if it is the last and only cut in December, then I guess the bond markets will have to rest content with where they are now. Thank you very much, Abhishek and Devang, for joining me and giving us your idea of how the bond markets might interpret the minutes and what you all are expecting in the days to come. Basically, the minutes are clearly telling us that there is space for a rate cut, and that may be one more in December. It's clearly to that extent a benign or a dovish policy and a dovish set of minutes. That's it on this special show on the RBI MPC Minutes. Thanks much for watching. There's news and updates lined up for you after the break.